Buying a stock based on an internet tip is a reliable way to lose money. Even if the tip is right and the company is great, buying a good business at the wrong price will still wreck your portfolio. To strip away the market noise, we evaluate stocks using a strict framework called DVM. We measure a company's financial durability, its valuation, and its market momentum, health, price, and timing. Today, we are putting a real company through this test. Our target is Apcotex Industries, a synthetic rubber manufacturer in the auto component sector. The stock is currently trading right around 611 rupees. Our goal today is to build a complete independent investment thesis from scratch using the raw data. Relying on a rigid framework forces us to look past daily headlines and measure the actual mechanics of the business. Let's start with the health check. Durability measures survival, generating cash and handling debt. Apcotex holds a durability score of 90 out of 100. This score is built on a return on capital employed of 21.1% and a debt-to-equity ratio of just 0.1. They owe almost nothing. Growth data reveals a spread between profit and sales. Net profits skyrocketed 88% year over year, while top-line sales grew just 4%. A line graph explains this anomaly. Operating profit margin expanded to 12.2%. The company became drastically more efficient at turning sales into profit. Stalled revenue often scares off retail investors. Tracking margin expansion isolates the internal operational improvements of the business, even when top-line growth is slow. Now we move to valuation. Apcotex has a current price-to-earnings ratio of 19.7. To know if that price is cheap or expensive, we need context. This horizontal bar chart compares Apcotex against its major industry peers. MRF sits at 23.3, Apollo Tires is at 19.8, and Apcotex comes in as the most affordably priced of the group at 19.7. This historical line chart maps the company's PE ratio over its timeline. The current 19.7 sits near the bottom of its historical range. The stock has spent only 10.8% of its history trading below this multiple, placing the current valuation in the strong buy zone. A PE ratio is meaningless on its own. Affordability is proven when the price is lower than industry averages and its own historical baseline. The final pillar is momentum. This tracks current buyer demand. Apcotex holds a momentum score of 74. This chart tracks the raw stock price interwoven with its simple moving averages. These smooth lines cut through daily volatility to identify the market trend. The current price of 611 sits clearly above 7 out of the 8 major moving averages. Pause the video right here. Look at these 3 scores. We have high durability, low historical valuation, and strong upward momentum. Formulate your own thesis before we reveal the final consensus. Building your thesis on the intersection of business health, price context, and buyer momentum eliminates guesswork. The checklist reveals the final verdict. Apcotex clears 19 of 23 criteria for an 82.6% pass rate. A stabilizing factor is insider confidence, with promoters holding 58.2% of shares. The primary red flag is revenue. Failing consistent sales growth makes margin maintenance critical. Factoring in both the risks and the margins, the aggregate analyst estimate sets a target price of 700 rupees, representing a 14.5% upside from the current baseline. Here is your DVM cheat sheet. Verify health with high ROCE and low debt. Confirm price by checking PE against peers and history. Time your entry by ensuring the price sits above major moving averages. No company has a flawless balance sheet. Consistent investing is about weighing the totality of the data, acknowledging the red flags, and building your convictions on the math.